All right, it's showtime. Hi, folks. Today we're covering a very important topic, which is the basics of Social Security retirement benefits and how to create Social Security strategies in order to maximize you and your family's lifetime benefits. Which begs the question, why should we even consider approaching our Social Security benefits from a strategic point of view? Well, before we jump into it, I'd like to tell you a couple of quick stories that I've experienced to drive home the point somewhat as it relates to why you should be educated on Social Security and how it can make such a big difference in our lives when we are. First, at a routine meeting with a prospective client about 6 years ago, I sat down with a couple where he was age 70 and she was age 65. He had worked paying nearly the maximum into his Social Security over 40 years, and he had been collecting his benefit since he was age 65. She had not worked when she was younger and raising their children, so she believed that her spousal benefit would be much lower than if she had her own worker benefit to draw from. So she had started her own cleaning company about 8 years prior to that, with the goal of paying enough into Social Security over 10 years until she was eligible. It turned out, though, that even if she had paid in for the full 40 quarters or 10 years, her worker benefit would still not have been as much as the spousal benefit that she was already eligible for prior to even working at all. And she didn't even know it. Well, I have to tell you, they were stunned to hear that news. Second, I sat down with a woman who was a 60-year-old doctor about 5 years ago. She was wondering when the best time would be for her to take her Social Security benefit. She told me that she had asked her accountant, and he told her that since she had a six-figure savings and a six-figure income, or seven-figure savings and a six-figure income, that it wasn't really going to matter when she took it because it was really just going to be cream on top of everything she had. So she was going to actually take it at age 62, given the advice that she was given. They both had no idea that based on the Social Security rules, she would not only have been penalized her entire benefit amount for the first 4 years, but when she did eventually start getting it, it would be reduced by 25% for the rest of her life. To say the least, she was extremely surprised to find that out. These are just two examples of how important it is to know the rules when it comes to filing for your Social Security benefits. And what's even more important is to find out the correct timing on when you and your spouse, if you're married, should take your benefits. If you're interested in getting the most money you can from the Social Security system over your lifetime. Now, these are the things that we're going to discuss on our webinar today. First, I'll give you a little history and facts about the Social Security system that most people should probably know. Then we'll discuss the rules when it comes to not just the Social Security system in general, but also each of the individual types of election choices that we all have available to us. Once we do that, we'll look at some sample scenarios that could be used for strategies to enhance both a couple's and a single person's Social Security benefits. And in doing so, you'll be able to see for yourself exactly how much a difference it can make when implementing a good Social Security strategy. Okay, now that you guys have a clear understanding of what we're going to cover today, before we jump into it, I'd first like to thank each of you for joining us today to discuss this very important topic. My name is Brian Dougherty of PLC Financial Solutions, and I'm your host and presenter for this today's webinar, along with my beautiful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hello.
Rachel's going to be our moderator for it, as always. But before we get started, let's take care of some general housekeeping first. So first, if the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen to make it larger. Oops. To make it larger. Sorry, guys. Lost my place. Okay. Also, you'll see that there are two boxes at the bottom of the screen, one called chat, it's for your comments, and the other called Q&A for your questions. Please use them accordingly, and Rachel will respond in kind. Next, I'm sure that many of you guys will have questions about the material as we go along. However, since we have a good bit to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in those boxes, because at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link for you to schedule that at the end of this webinar if you so desire. All right, next thing. This webinar is being recorded and it will be sent to everyone who is attending today. So don't worry about missing anything. You'll have plenty of time to check it out at your convenience. Also, because we want to make sure that you're all paying attention as usual, and because we'd like you to have some fun as well, before we answer any questions, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure that you have a notebook handy to jot down some brief notes related to some special bullet points that I'll point out as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. Whew. Okay, now that we got that over with, I have one for you as usual, and it's a new one, Rachel. So here you go. Why don't scientists trust atoms? Because they make up everything. And that I did not get from my kids. I looked that up myself on the internet today. Do you like it, Rich? All right, thumbs up. Cool. I'll keep the day job anyway, though. All right. I also want to mention that much of this material that we will be covering today has been obtained from the Social Security Consulting LLC website and their nonprofit sister company, the National Social Security Advisor Certificate Program, which is our nation's only accredited Social Security certificate program and the source of my own Social Security Advisor certificate. As you can see, 9 out of 10 people aged 65 and older are receiving Social Security benefits, which of course makes it a very big part of our retirement plans, and that much more important to plan ahead when it comes to it. Because the employees at the SSA, the Social Security Administration, although very well trained, are directly instructed to specifically not give advice when it comes to people's election choices and helping them to make the best choices with them. This means that you have to know what's best for you and your family before you sit to file your claim. Whether it's at the SSA office or online, it does not matter. Okay, some history related to Social Security. It was passed into law in 1935 under President Franklin Delano Roosevelt. People actually started receiving it, though, in 1937. Now, the family and survivor benefits weren't implemented until 1939. The first inflation adjustment, though, was in 1950, and it was for a whopping 77%. Everybody thought the 7% they got this year was big, right? Everybody'd like to get that one, maybe next year. Hopefully inflation won't be that bad this year. Okay, Medicare. The Medicare Act was passed in 1965 under President Lyndon Johnson, which started the Medicare program. The first annual automatic COLA, cost of living adjustment, also known as the COLA, the COLA, was passed in 1972, but did not go into effect actually to 1975. It started being taxed, though, in 1983 under President Reagan. And the penalty for working while collecting Social Security was eliminated for everyone at their full retirement age and beyond in the year 2000 under President Clinton. Now it's actually for everybody under their full retirement age. They're the only people it retained. And 2022, it's the Social Security system's 87th birthday. Happy birthday, Social Security. All right, let's discuss some of the differences in the circumstances between what things were like when the fund first started and how things have changed over the years. First of all, in 1935, the average life expectancy was under age 60, sadly to say. Most people would not have ever even collected because you couldn't collect till you were age 65. It was actually only designed to be a supplement retirement savings. The worker to retiree ratio was 160 people paying into the system for every one that was taken out. The total amount of benefits that were paid out in the first year it went into effect in 1937 was only $1.2 million total. This is a whopper. The poverty rate for seniors was 50%. 50%. Amazing. Now, what's it like today, especially since we've had Social Security for 86 years? Well, life expectancy's changed a lot. Average life expectancy is 82 for a male, 85 for a female these days, which means people can actually outlive the retirement savings, making Social Security that much more important and more than just a supplementary retirement for some people. Social Security makes up 40% of all current retirees' income. The worker to retiree ratio today is 2.8 people paying in for every one taken out. What a huge difference. It was 160 to 1. Now, the total benefits paid out annually in 2019 was just over $1 trillion, $1.048 trillion, compared to 1.2 million in 1937. Now, this is a good one. The poverty rate for seniors is down to 9.5%, which is largely due to Social Security. Okay, let's look at the growth. We just talked about it. Let's look at the specifics of it over the last 86 years. Like we said, it was actually just shy of 1.3 million, the amount that was paid out in 1937. 1950, geez, only 13 years later, it was up to 961 million. And then it was at in 1980, 247 billion. And then in the year 2000, 407 billion. And it finally crossed over $1 trillion in 2019. So, man, you can see stayed relatively calm from 1937 to 1980. Then look at the major jump since 1980. So these are the different types of benefits and the percentage of amount that's paid out towards each of them of all that money. A little over 70% is workers' benefits. Only 4% is spousal benefits, which is really surprising, right? I mean, that's probably due to the fact that two families have to work these days. People are claiming their own benefit more. Children's benefits a little over 6%, widowers benefits a little over 6%, disabled workers a little over 13%. Okay, let's talk about a really hot topic when it comes to Social Security. Will the benefits be there for us when we retire? Everybody wants to know this, right? Well, let's look at some of the facts about it. First of all, the full name of the Social Security Trust Fund, which is nothing more than a big savings account where all the annual surpluses from the revenues that are paid into our Social Security program since its inception have been saved, is the Federal Old Age and Survivors Insurance Trust Fund. Now, this is an older slide, and I actually looked up, I could get some of the newer numbers. On 2021, it was actually $2.908 trillion in it at that time. It's also all made up and only allowed to be made up of all U.S. securities. That means it's made up of either U.S. Treasury bills, notes, or bonds. Now, 2019, it had a $2.5 billion surplus in the fund. Now, what does that mean? The problem with the fund is it has been projected that the income it receives every year, which comes from three main sources right now. First is the Social Security payroll taxes. The second is the income taxes retirees pay on their Social Security benefits. And the third is the interest on those U.S. securities that are inside the fund. The total of the three in 2019, total amount, came to $1.061 trillion of revenue that came in that year from those three sources. And the breakdown was like this. 945 billion of that came from the Social Security payroll taxes that we all pay. They cap off at about $142,000 right now. The second, what came from 36 billion came from the Social Security income taxes that retirees are paying on their Social Security payments. And the third was from the 81 billion of that 1.06 trillion came from the interest from the U.S. securities. Now, even though that's a lot of money, and at some point it will still not, because at some point it's still not going to be enough to cover the expenses the fund has, which include all the Social Security benefits that are being paid out every year and the administrative costs related to operating the fund. All that, how much is paid out and those administrative costs in 2019 came to $1.059 trillion. That little difference between the income and the expenses was $2.5 billion. Makes $2.5 billion seem like that, right? I mean, just crazy. But So it's actually almost a break even already. But I looked it up, and I think it's down to about $2 billion now, the surplus, 2021. So when it comes to the expenses, so when the expenses eventually do exceed the income at some point, the $2.9 trillion in US securities inside the Social Security Trust Fund will need to start being liquidated every year, a little at a time, in order to pay the expenses that currently the three income sources will not cover. It'll be a little bit every year. So how long will it take to use up the entire $2.9 trillion in the fund? Which really is, like I said, just a big savings account for a rainy day for the program. It's estimated that will run out somewhere between 2034 and 2035, which is just when I'm going to turn 67 and technically supposed to be able to collect my full retirement benefits. So and since by law, the Social Security system cannot operate in the red and will no longer have the rainy day fund to pull from, the big question then is, what's going to happen to our Social Security benefits then when the trust fund runs out? Well, at that point, the only sources of income going into the fund that will be available to pay our Social Security benefits and the administrative expenses for the fund and the pay are the payroll taxes, also known as the FICA tax, and the income taxes on the Social Security benefits that our retirees have to pay every year. The securities and the interest are going to be gone. So it's been estimated that at that point, only about 79 cents on every dollar promised to people will be available to pay our Social Security benefits. So about 79%, we'll get about 79% of what we thought we were going to get. This means, as of now, the worst case scenario is that our Social Security benefits will be reduced by around 21% as of what we're expecting to receive, So it will still definitely be there for us, but we just won't be collecting as much as we originally were promised and as much as those who came before us received on a dollar-to-dollar basis. I hope we cleared that whole problem up, or whether it's going to be here for us or not. It's going to be here, but if we don't do something, it's not going to be as much as we thought it was going to be. It's going to be close to about 80% of it. Since the Social Security Trust Fund is going to be getting whittled away at over the next 13 or 14 years, there have been many ideas that have been tossed around Congress to solve the problem before it gets out of hand. Here are the leading considerations. First is move the full retirement age from 67 to 70. In some ways, that makes sense a lot, only because of life expectancy being so much greater than it was when the fund started. So that could happen. I don't know if it'll go to 70, but it could. Second, all earnings would be subject to Social Security payroll tax. Like I said, which was it's around, it's about $147,000 right now, the cap. That's right. It went up to 147 for 2022. This is actually the one that I think will work the best. And I actually listened to a podcast that had a Morningstar podcast, had a economist on there from actually Notre Dame, Teresa Giarducci, her name is. And she actually said, if we uncapped it, would actually pay up the fund for the next 75 years and could actually increase our benefits to the lowest 10% of people receiving them now, which I thought sounded pretty good. This one I hate, means testing. Could you imagine that? You're paying for this for all them years. I don't care how much money you have. whatever it is, it's a savings plan. If you're putting money in for it, you should be entitled to get it. Shouldn't have to prove you need it. Decrease the percent of the delayed retirement credits. I could see it. We'll talk more about what they are. Wouldn't like to see it, but it could happen. Delayed eligibility age could get pushed back from 62 to 64. That's conceivable too. And then there's another one. I don't think this is probably going to happen. Reduce the COLA adjustment. Use the change CPI-U index instead of what it's currently using the CPI-W. But it really should be using the CPI-E, which I'm not going to get too much into now, but for elderly. But I don't know. Maybe that could happen. It wouldn't have a huge impact the way the others would. All right. Now, before we start looking at the rules related to Social Security, here are the four main categories of benefits that are available. The first is retirement benefits. They start at age 62. They stop growing at age 70. The second is survivor benefits. Surviving spouse gets the higher of the two benefits. Disability. You have to qualify for disability benefits, though. And family benefits. They can pay out as much as 180% of the worker's benefit to dependent family members if you have two or more. Okay, let's jump into the general rules. Throughout this workshop, you'll hear a few terms and abbreviations related to Social Security. These are the most common that you should definitely be familiar with. The first is the FRA, or the full retirement age. That's the age at which a person may becomes eligible for full or unreduced retirement benefits. Second is the PIA, or primary insurance amount. That's the benefit a person will receive if he or she elects to begin receiving retirement benefits at his or her full retirement age. At this age, the benefit is neither reduced for early retirement nor increased for delayed retirement. The third is SSA, which is simply the Social Security Administration. And the third is the COLA, the cost of living adjustment. We already talked about them already. So let's talk about how to determine your full retirement age. When the fund started, everyone's full retirement age was age 65. Then Congress decided we needed to push the full retirement age back to eventually be age 67. But they made it where the largest block of folks born between 1943 and 1954 would have a full retirement age of 66 in order to drag the process out for a while. And then everyone's full retirement age who was born between 1955 and 1959 would increase in 2-month intervals. The same was true for everyone born between 1938 and 1942. And finally, everyone who was born in or after 1960 would have a full retirement age of 67. So, how do they determine how much our benefits are going to be? First, they multiply your past earnings by an index factor in order to adjust them for inflation. Second, they take your highest 35 years of earnings and they add them all together. Third, they divide that total number by 420, which is the number of months in 35 years. The final number from this equation is referred to as the AMI, which is in short for the average indexed monthly earnings. This is not what determines what your benefit amount is, though. To determine your benefit amount, your AMI is used in what is called a bend system, which is a little too time consuming for this workshop, but it works a lot like our tax bracket system. All you need to know, for now anyway, is that the result of the bend formula is what they refer to as your PIA, or primary insurance amount. And that is how they determine what your full retirement age Social Security is, Social Security benefit is. So here are the rules related to the individual benefits under different circumstances. Now, collecting Social Security benefits before your full retirement age, your FRA, will cause your benefits to be permanently reduced. See the percentages on the graph? This chart shows how much the benefits will be reduced if your full retirement age is 66. And for the purposes of this class today, we will continue to use the age 66 as the full retirement age. So you can see if you collect before at age 65, you're reduced by 7%, 64, 13%, 63, 20%, 62, 25%. And the same is true if you delay your retirement. As you can see, collecting Social Security benefits after your full retirement age, your benefits increase by 8% per year until age 70. This is simple compounding on top of getting the COLA adjustment. Of course, if you change the full retirement age, the percentages of the decreases and increases of your benefits will change slightly as well. That's why we're saying for this presentation purposes, we're just going to use age 66 as the full retirement age. Now, when it comes to working while collecting Social Security, these are the rules. Remember, Social Security benefits were intended to supplement retirement income. So the Social Security Administration really wants you to be retired when you collect them. Therefore, they'll penalize you for collecting early if you are not actually retired. If you collect benefits early, you will be subject to what's called the annual earnings test, which looks exclusively at your earnings every year. Prior to full retirement age, if you earn more than the threshold amount of $19,560, that's the 2022 number, you'll lose $1 of benefit for every $2 earned over that threshold. Now, keep in mind, this is on top of the already receiving a reduced benefit for the rest of your life. Although in the year that you reach your full retirement age, a different rule applies. The threshold goes up a good bit to $51,960. And the rule is that you will lose one for every $3, for every $1 in benefits, for every $3 earnings over that threshold. So you're going to lose $1 for every 3 that you make over instead of every 2. So they increased increased the threshold a great deal, more than double, and they actually reduced the amount of the penalty substantially as well. Now, once you make it to the month in which you turn your full retirement age, not your actual birthday, but the first day of the month that you turn your full retirement age, then there's no more thresholds that apply, and you can earn as much as you want with no reduction in benefits applied. And so you know, this applies to all Social Security benefits except Social Security disability. There's different rules related to that. They do have working income rules way different than these though. So it applies to individual benefits, spousal benefits, child benefits, and survivor benefits. Anybody who's collecting on your claim will get reductions if you work. Okay. You should also know that these penalized benefits are not kept by the Social Security Administration forever. They're returned back to you once you turn your full retirement age, but not in a lump sum. They're distributed evenly from the time you reach your full retirement age until you reach what the government sees as your life expectancy age. Now, if you don't make it to that age, then either you're a spouse or your family whoever's collecting benefits on you will get what's remaining on that. But if they don't live to the same year that you were going to be that age, well, then those benefits are lost. Now let's talk about spousal and survivor benefits. When it comes to spousal benefits today, the number one thing you must understand is what the term deemed filing means. And it's actually pretty simple. What it means is if you were born after January 1st, 1954, when you file for your benefits, it's considered that you were filing for all the Social Security benefits that you were eligible for at the same time. So if you're eligible for both a worker benefit and a spousal benefit, then you are filing for both and will receive a combination of both in your benefit. This was not always the case, though. At one time, you could file for one and leave the other grow in the system until a later date, which was usually age 70 for most people. This allowed folks to more easily maximize their benefits, but that stopped as a result of the Bipartisan Budget Act of 2015. Okay, so how does deemed filing work? Well, to explain this, we're going to refer to our fictitious couple who you're going to hear about on and off and pretty much through to the end of Samantha and Jeremy, who you're going to hear. And in this scenario, Jeremy is the higher earner who filed a worker's benefit, whose full retirement PIA, remember that, primary insurance amount, is $2,200. And Samantha is the lower earner who files a spousal benefit. When Samantha turns her benefit on, she's now required to take her spousal benefit, or what the SSA calls the spousal boost, at the same time, because her spouse, Jeremy, is already receiving his worker benefit. So let's say that Samantha's full retirement age benefit is $600. If she collected at age 62, it would be reduced by 25% to $450. If she waited until she was age 70, it would be increased by 32% to $792. Now, when you add her spousal benefit to the equation, you can then see how it gets a little tricky, because her maximum spousal benefit will never be more than 50% of Jeremy's worker full retirement age benefit. So how does the SSA make sure that happens with claimants? By just proclaiming that your own worker benefit and your spousal benefit are never going to be aggregated, they call it, but rather what they call coordinated. That means that Samantha's spousal benefit at its core is only ever going to be worth a maximum of $1,100, which means if she collects her spousal benefit at full retirement age, along with her own benefit, she'll add an additional $500 of spousal benefits to her own worker benefit of $600, for the total of, you guessed it, $1,100, which is 50% of Jeremy's PIA. If she files, though, her benefit at age 62, her $500 spousal benefit will be reduced by 30%. To $350 for a combined worker and spousal benefit totaling $800. So you see that there? You see where it says 25% reduction on hers, but it was actually a 30% reduction on spousal benefits. So only a portion, her spousal boost portion, is reduced by that 30%, and her worker benefit is reduced by the 25. Now you're coming up with $800, where she would have had, if she was getting 100% of both, she would have had $1,100. This is where it gets tricky. On the other hand, if she waits till age 70 to file for her Social Security benefits, even though her worker benefit will increase by 32% to the $792, here's where they get you. Her spousal benefit is actually reduced to $308. This is because $1,100 is all they will pay her when it comes to her total benefit, because her worker benefit is less than half of Jeremy's worker benefit. Now, I hope that was clear enough. It's a little complicated, but at the end of the day, the bottom line you got to realize is that she's only getting 50% of Jeremy's 2,200, which is 1,100, and they kind of manipulate things to where it's like that no matter what. Okay. There are also a few details you should know, should understand when it comes to spousal benefits. First, you have to take your spousal benefit at your full retirement age in order to receive the full 50% of your spousal full retirement age worker benefit. Second, you have to be at least age 62 in order to qualify to receive a spousal benefit. And of course, at that age, it will be reduced by 30%. Third, you must be married at least 12 consecutive months to be eligible for a spousal benefit. Remember that I said that. Bullet point. Right? Fourth, when you file, if you're eligible for both worker and spousal benefits, the end result is that you will receive the higher of the two. And finally, if your spouse were to pass away while you were still married, you have to be married at least 9 months to receive a widow or widower benefit. Remember, I said that. If your spouse passes away while you're married, you have to have been married at least 9 months. Okay? But to get a spousal benefit, which is a living benefit, you have to be married at least 12 months. Don't forget them. All right. The only exception to the 9 months, though, in the survivor benefit is that if your spouse passes away as a result of an accident or from active military duty. So when it comes to divorced spousal benefits, you have to have been married at least 10 years. Remember, I said that. You have to be married at least 10 years in a divorced spousal benefit. Was that bulletproof or bullet pointed enough, Rach? Okay. You have to be currently unmarried, though. To get a divorced spousal benefit, you can't be remarried. You and your ex-spouse must be at least age 62. So both people have to be age 62. If you're divorced for less than 2 years, then your ex-spouse must be receiving either retirement or disability Social Security benefits for you to be eligible to receive a spousal benefit. So if you get within the first 2 years of divorce, if you wanted to try to file a claim, the only way, a spousal claim, the only way you could get it is if your ex was already filed a retirement benefit or on Social Security disability benefits. However, if you were divorced for more than 2 years, your ex-spouse does not need to be collecting a Social Security benefit, and you could still be eligible to collect. All right. Now let's talk about divorced survivor spousal benefits. Okay, that was divorced spousal benefits. This is divorced survival spousal benefits. So for someone who's, this is a situation where the ex-spouse actually passes away after you were already divorced. You have, you have to, again, have to have been married at least 10 years, but you can collect on them. You must be at least age 60 though, or to collect it, you could be age 50 if you're considered disabled. However, whenever you collect any Social Security benefit before your full retirement age, they will be reduced benefits. Now, after age 60, you can be unmarried, or you can actually be married to somebody else new and be eligible. Again, it will be a reduced benefit, but this is the caveat. You can't get remarried before age 60. It's at age 60 or after. And you can still collect that survivor benefit, spousal survivor benefit. Okay. Now let's take a look at some advanced filing strategies so you can see for yourself how your benefits could be increased by timing and planning to file them at certain strategic times. Before we discuss some of the different strategies to consider, let me state a few bullet points. First, again, remember that since Social Security claims reps are not allowed to give you advice to help you to maximize your benefits, you have to create your own plan to do it. Second, if you're part of a family where multiple people will be eligible for benefits, husband and wife, could be a disabled child, could be several other people, doesn't have to always be a spouse. It will give you a greater opportunity to maximize your benefits. So the more people involved that can be involved, the more strategies can actually be created to increase the overall family benefit. Third, to really fine-tune a plan to get every penny out of the system, you can't be thinking in terms of taking your benefits at the standard exact ages of age 62, when you can first get it, 66 or 67, which is full retirement ages, or 70. Can basically eliminate those ages from the equation when you're trying to maximize. That's called inside the box thinking, and it 99% of the time will not produce a maximum benefit situation. Fourth, you have to micromanage the benefits by taking into consideration all the various benefit types that each person is eligible for and the combination of all 96 months that each person is eligible in. And then combine each person's optimal months for each benefit available to them together to find the combination that will produce the maximum amount received overall. This is what's called situational Social Security, or out-of-the-box thinking. It takes a little doing, which is probably why 90% of the people don't do it. But believe me, it's worth it, especially over your lifetime. Don't rely on claims reps to help you. They're not allowed. Okay, one of the things that for you to consider prior to creating your plan is whether you or your spouse were born prior to January 1st, 1954, which means you'd be about 68 right now. If you were, then you'd actually have an option that others born later don't have anymore. This is because, like I mentioned before, in 2015, the Bipartisan Budget Act was passed by Congress, and it began a phase-out process for 2 of the 5 claiming choices that were available at that time. The first was the file and suspend strategy, which absolutely was our gold standard. That got phased out actually pretty quickly. It ended on April 29, 2016. It was available to allow claimants to choose between taking either their worker or spousal benefits separately and leaving one of them to grow to a later date, regardless of whether their spouse had filed for benefits or not. That actually stopped on April 29, 2016. The second, though, is still available to some people, but it will be completely phased out once everyone who was born on or before January 1st, 1954, once they all turn age 70, it's gone forever. It's called a restricted application, and it allows you to claim a spousal benefit off your spouse's work record while leaving your own worker benefit to still earn delayed retirement credits until age 70 if you'd like. That's an 8% increase that I showed you. Although this strategy is only available to folks born by that magic birth date, if you were, you should definitely give some serious thought to when it comes to creating your own personal strategy. Definitely can boost a lot. We'll talk about it a little. Let's finally meet Jeremy and Samantha, our fictitious married couple, planning out their Social Security benefits. Jeremy, in this scenario, is the higher wage earner, and they both have a full retirement age of 66, which means that they were both born before January. Well, yeah, because for it to be 66, they'd have to have been born by 1954. Otherwise, the full retirement age would be further along the line, down the line. So in this situation, Jeremy and Samantha have the restricted application available to them. It makes it interesting for us to be able to show that scenario. Okay, if they both started collecting at age 62 and had life expectancies fairly short, only age 75 for Jeremy and 82 for Sam, then Jeremy would receive his own reduced monthly benefit of $1,650, which is reduced by 25% if he took it at age 62. Samantha will receive her own reduced monthly benefit of $450, like we talked about before. Again, reduced by that 25%. In addition, she'd get that spousal boost of that $350, which is her $500 reduced by 30%. She'd get that until Jeremy passed away. And in this scenario, we're saying at age 75. When Jeremy passes away at 75, Samantha would be eligible to receive his $1,650 for a survivor benefit, which is just the greater of the two of their benefits. At the end of the day, they'd receive, all told, out of the Social Security system, $550,200. Okay, now had Samantha and Jeremy both waited until full retirement age, Jeremy would have received his full retirement age benefit of $2,200. Samantha would have received that combination of her $600 and the $500 spousal boost, totaling $1,100. When Jeremy passes away, again at age 75, Samantha would then be eligible to receive his $2,200, the higher of the two. Even though they received benefits for a lesser period of time, because they received higher amounts, they actually received $580,800 back, which is roughly $30,000 difference from both of them collected at age 62. Now, let's look at the age 70 scenario. Had they both waited until age 70, they would have only received $532,224. Because remember, he's only living to age 75, and she's only living to 82 in this scenario. When you don't have longevity on your side, in this case, waiting to age 70 would not always be in your best interest. That's why it's suggested that you always consider your potential life expectancy along with different age and benefit combinations to see which will provide you with the greatest amount of benefit and flexibility under the different circumstances. Now, let's get creative a little. What if the lower earner, in this case, Samantha, started collecting at age 62, but Jeremy waits to age 66? Since Jeremy has not filed at first, Samantha would only receive her worker benefit. She's not eligible for the spousal benefit. Many times, this is a very good strategy for a lower earner, spouses to use while the higher earner spouse waits until their full retirement age or later. Plus, if the higher earner was born by January 1st, 1954, they could even file a restricted application at their full retirement age and receive a spousal benefit while their worker benefit keeps growing as much as 32%. In the scenario shown here, Samantha begins collecting her reduced worker benefit of $450 at age 62. Jeremy decides to file his worker benefit at age 66. In turn, Samantha is now eligible and begins receiving an additional $500 spousal benefit when Jeremy files that. Also, because she's at her full retirement age, when she begins her spousal benefit, that portion is not reduced anymore because she started her own worker benefit still going to stay reduced, but her spousal benefit is not reduced anymore. She's actually got a combination of reduced benefit and an unreduced benefit at the same time. Now, because she's at her full retirement age, she begins the spousal benefit, that portion not being reduced. At the end of the day, by using the strategy shown here, Jeremy and Samantha collect $584,400 from Social Security throughout their lifetime, which is greater than what they would have received at their inside the box ages of 62, 66, and 70. This is the result of using a situational Social Security or out of the box claiming strategy. So they're looking at an extra $50,000 or more by wiggling things around and making some delays on certain things. Now, let's add some longevity to this mix. If Jeremy now lives to age 85 and Samantha to 92, this strategy no longer provides the largest amount of benefits. The best option for Jeremy and Samantha in this case would be for them to both begin collecting at age 70, where they would collect almost $50,000, even more than that, throughout their lifetime, opposed to the strategy that would have worked best for them had they not had longevity on their side. In fact, with longevity on their side, them both taking their benefits at their full retirement age in this situation would also work out to be slightly better than the other scenario, producing an additional $14,400 more than the prior recommended strategy without longevity on its side. Again, you can see here why it's important to look at several different scenarios and to do your best to apply what you think is more likely to prevail in your situation, whether longevity or not. All right, we're getting close. So let's keep longevity on our side, mix up things a little. This is an option that should be considered when you have a couple that both have spousal benefits that are lower than their own worker benefits. Okay, so in this scenario, not only do they have longevity, but their actual spousal benefits are less than their worker benefits are. So here, Jeremy decides to collect his benefit at his full retirement age, which gives Samantha the choice of collecting her own worker benefit of $1,400 or her spousal benefit of $1,100 because he's filing. If she chooses to collect her spousal benefit, this is when she has to file a restricted application, which would allow her own worker benefit to continue to grow up to age 70. If she's so inclined to do so, could be 68, 69, certainly going to be more either way. Then she can switch to her increased worker benefit, in this case of $1,848. As you can see, Jeremy and Samantha both start collecting at age 66, but notice the difference filing a restricted application makes for Samantha as opposed to filing off of her own record at that time. It's a difference of almost $72,000. Of course, this strategy won't work if Samantha doesn't file the restricted application because the SSA will automatically compare the individual benefits and the spousal benefit and pay the higher of the two. And it cannot work if Samantha and Jeremy decide to file their claims before their full retirement age, because you can only file a restricted application at your full retirement age. It's not available to you prior to that. Also, notice that if they both wait until age 70 to collect, they'll maximize their benefits throughout their lifetime, providing them almost $1.15 million plus, which is roughly $36,000 more than the strategy shown here. Note, Samantha must have been born again by that magic date of January 1st, 1954 to file that restricted application. So now let's look at one last scenario in a widow situation, widower situation. This could be it for an individual. It doesn't have to be a family. So this it gives you the potential to switch between benefits. Is it in this scenario when a widow or a widower is entitled to survivor benefits and has a good sized worker benefit of their own as well? In many cases, folks like Jeremy and Samantha might compare their worker benefit to the survivor benefit and just do what seems logical and take the higher of the two. They might say, all right, I'm 60. Well, you can't get a worker benefit at age 60. You can only get a widower benefit. But if they waited to age 62, they might just say, well, give me the higher of the two. Okay. However, the best way to maximize their benefit would be to start collecting one and then switch to the other at age 70 so it can grow that 8% per year over those extra 4 years. So in this scenario, if it was Samantha, she would collect her survivor benefit at age 60 because you can collect one at age 60. So it gives you 2 extra years. Thus, by receiving a reduced survivor benefit for the first 10 years collecting, she allows her worker benefit to grow all the way up to age 70. Then at age 70, she begins collecting her own worker benefit, which is grown to $2,904, 132%. Using this strategy could boost her lifetime income by around $200,000. It also allows her to collect just under $1 million through her lifetime. Wouldn't it be great to collect an extra couple of $100,000 through your retirement as well? All right. So the big question for you folks on this webinar today is, how can this work for you? Which is, of course, why many of you chose to attend this workshop today. So here's what my thoughts are when it comes to that. And it's also what I've decided, why I've decided to extend a pretty good offer out to everyone on the webinar too. These recommendations are for all you do-it-yourselfers out there like myself, okay, I would without a doubt seek out some more advanced education on the topic of Social Security and Social Security planning, because there's quite a few rules that apply to each type of election choice and the various benefits that Social Security offers. Plus, I would definitely read some Social Security related books. Go to Amazon and search Social Security planning books. Take an online class. The National Social Security Advisors have several good ones. You can go to www.premiernssa.com. They're the folks that I got my certification through. Secondly, I highly recommend investing in a good Social Security planning software. There are actually some great ones out there. Maximize Your Social Security is one. Social Security Timing is another one. And Social Security Visualizer. There are all a few good, pretty affordable ones out there. Finally, if these two recommendations are not an option for you, then seek out a good Social Security advisor to consult with. You can actually even go to the SSA, Premier SSA, and you can look up Mark Kiner. He's the guy who I got my certificate from, and they have all the lists of all the different Social Security advisors that are under at least their certificate program. So folks, that concludes our workshop for today. But before we move on to our 6-question quiz and to answering any questions that you have, I'd like to extend an offer to everyone on the webinar right now. We have 3 Social Security planning packages that we currently offer with clients. We'd like to offer, extend this to everyone on tonight's webinar. This no obligation offers related to each of these Social Security services that we provide. First, it's just a basic Social Security online application assistance package. We actually help people sign up for the Social Security online. We generally charge $250 for that, but if you sign up before the end of tonight, midnight, we're going to do 50% off on that. You pay $125. We also provide something called a Social Security maximization package. Generally charge $375 for that. We'll give you it for $200. And that basically it basically looks at your Social Securities in a vacuum. We would just need your Social Security information. We wouldn't need any other information. And we could run up what the ideal recommended strategy would be for you, because we have software to do so, to file for you and your family, so you wouldn't have to guess. And finally, there's something called a Social Security personalization package. Usually we charge $500. Now we're actually going to offer this complimentary, okay, for anybody who signs up for at least the first 1-hour meeting for that, because it'll be a couple of meetings. But this is actually a situation where we take all your personal situation into account with your Social Security information, and we put it all into several different softwares, and then come out with our retirement planning software. And we can not only recommend what the best Social Security strategy is as far as timing is concerned, but we could also recommend it based on your personal situation. And we can let you know if a particular strategy that you are in favor of could work for you or not. And we're offering this complimentary because it's our most valuable package. And we really want to be able to offer you as much value as we can today. All right. So Rachel is going to put a link up there, and all you have to do is book the first 1-hour meeting before midnight tonight, and that'll lock you in. Same with these others. There'll also be notes when you book that off the link. And if you're just looking to do the online application, then put that in the notes. Or if you're just looking to do the Social Security maximization package, put that in the notes. Or if you're looking to do the Social Security personalization package, put that in the notes. All right, folks, that concludes our presentation for today. So we can now jump into our 6-question quiz. You have those questions there? I have them here, Rachel. Let's do it. This is the best part of the show. All right. Remember, any answers you have, you're going to put them in the comment box. What year did the Social Security system go into effect? Not what year, what was it passed? What year did it go into effect?
It looks like it was Bob.
Bob got it.
Yep.
1937.
37.
Good job. Bob's back. All right. You know what, Bob? Put into anybody who answers them too. Just let us know where you want to guess the $10 gift card to. All right. How much in total benefits were paid out in 1937?
Oh, it looks like Bob again. 1.2.
Wow, Bob, you really were taking notes. In what year did the total benefits being paid out pass $1 trillion? Bob did almost hit it
Bob
once. I think
again.
we're gonna have to go with Marty on that one. They blinked. We had to spread the wealth a little bit, Bob. Good job, though, both of you guys. How long does someone need to be married? How long does someone need to be married to collect a spousal benefit? Ah.
Oh, looks like Marty got that one too.
Marty did get that one.
Yeah.
All right. How long does someone need to be married to collect the divorced spousal benefit?
Oh my God, they're going so fast.
Larry.
So Larry got that one?
Yep, 10 years. Yeah, you thought that was going to be the 9-month one, right, Marty? Okay, last one. What date does someone need to be born by to file a restricted application? I think Bob got that again. Let's see. Oh, no. Oh, no.
Well, it looks like Marty. Well, Marty got 54.
Yeah, I think Marty got that one. Yeah.
And then there was, it looks like Marty got 2 and Bob got 2.
Yeah, guys, I think we're going to go with KPH on this one. I hope you're okay with that. All right, guys, do us a favor. If you can right now, put into the comment box where you would like. I can tell you this: Amazon and Target, they make it the easiest for us to send we usually like to send the gift cards through email. But I know Bob's favorite of
Larry said Amazon.
Where is it?
Walmart.
Walmart, yeah. So we'll if you can, dump them in there, folks. Amazon, Walmart. How about you, Marty? And
He said Amazon too.
Did he? Okay.
Mm-hmm.
Then one last one was KPH. Amazon. You got them written down, Rach?
Yep.
All right, let's field some questions.
Okay, so. All right. Can I file for my spousal benefit and leave my own benefit to grow?
Well, not to be, facetious, but you can, if you were born by the magic date of January 1st, 1954. You can't if you weren't. Okay.
Okay, so how about another one says, I was married for 7 years
Mhm.
and my husband passed away when we were both 48.
Okay.
I'm 66 now, I'm remarried. Am I eligible for my survivor benefit?
What did I say the bullet point was again? Anybody remember? Survivor spousal benefits. Or how long did you have to be married for while you were, still alive together, if you were still married?
Right.
9 months. 9 months. If you were married for 9 months, unless it was an accidental death or by military. So yes, that person can collect their benefit, a spousal benefit. Now, here's the next caveat. They can if they got married before age 60. But if they waited till age 60 or later to get married, they can still. So that's the only caveat. All right, what do we got here? What do you got?
Okay, so another one said, my wife and I have a grandson living with us for the last 3 years. He's 11 years old and our daughter is disabled now and our son-in-law passed away. I'm 65 and my wife is 61. I started Social Security 2 years ago. Can our grandson collect a Social Security benefit too?
Holy smoke, that's a lot going on. Wow. All right, so they started collecting how long ago?
2 years ago.
2 years ago. And how long has the grandson been living with them?
3 years.
Okay, so that's a good thing. It has to be living with you before you start collecting. All right. And what was the rest?
They want to know if the grandson can collect
But I mean,
Social
what was
Security.
the other terms they gave? What did they say about the son or the daughter?
Oh, well, the daughter's disabled and they're is now disabled. I guess maybe she wasn't before. And the son-in-law passed away.
Okay, that's the other thing. That has to have all happened before you started claiming your benefit as well. So the son, grandson need to start living with you before you started your benefit. They either had to be either both disabled or just both deceased or deceased, one or the other, like in that situation, they're saying they are. So I think they're good to go. I think so. Yeah, I'd say that all that happened before he filed his benefit. That means his grandson should be eligible for benefits for him, under him. There's quite a few things that got to be under on place here for that one. I see this one here, Rach. He said, I'm 58 years old. So Marty, ready to retire, union, when best time to contact you to get the option? Do it now. I mean, we'll have to, see all your circumstance there, Marty, to give you the options. But yeah, anytime you should find out as soon as you can.
I'll put the link back up. Can we put the link up?
Yeah, put the link up. Click on that link, and you can just pick a date and a time. Supplemental offered till age 64. Oh, okay. So you got a Marty, you're saying you got a supplemental Social Security benefit through your union? Yeah, I've worked with some other people who have had that. Do you know what age? The one I worked with before, it was age 64 that you got to collect it till. Right. Okay. Yeah, you could be in good shape there, Marty. You could be really in good shape. Yeah, out of 420. Yeah. I have some other people out of 420. Yeah, you could be in good shape. Let's get an hour on the calendar and let's talk about it. One last one, Rach.
Okay, one more. We both wait until we're 70 to file our claims. Won't we then be ensuring that we get the most out of our Social Security benefits?
Well, we just actually talked about it, right? I mean, the biggest thing to wait till 70, I mean, unless your bills, you need to make that, both people need to make that age 70 benefit amount to be able to pay your bills. That's just a scenario you can't avoid. But if a couple is in a situation that, then the next biggest determining factor is longevity. If you have longevity in your family, and then you don't, it's most likely that, 70 will definitely get you the most out. But if it's not, you go with the odds being the life expectancy tables, then you're probably going to be better off taking it before 70. Usually somewhere between your full retirement age and 70. We just have to run it through the program to see when would be best. We good there?
Yep, that's it.
All right, awesome. So in conclusion, folks, I'd like to thank everyone who took the time out of their busy schedule to attend our workshop today. I truly commend you for being the type of people that are looking to better inform yourselves on important topics like this one today. So I also want to thank my wonderful partner in business and life, Rachel Dougherty. Thank you, Rachel. Again, folks, my name is Brian Dougherty of PLC Financial Solutions, located in the Fort Washington area. You can get in touch with us if you have any questions, either related to tonight's topic or anything else, by calling us at either 215-804-9708, or you can go to our website at plcfs.com and email us at info@plcfs.com, or schedule a complimentary 15-minute Q&A phone call meeting. And we can talk about whatever you want to talk about in those 15 minutes, answer some quick calls or quick questions. I'd be happy to discuss whatever it is you have. Also, folks, we hope to see you in our future webinars. We usually hold them on the last Tuesday of every month at 7 p.m. However, because next month, the last Tuesday is Rachel's birthday, April 26th. For the one time, we're going to postpone and make it the following day, Wednesday, April 27th at 7 p.m. Our topic next month will be understanding estate planning. Also, Rachel has posted the links to schedule that 1 hour meeting related to any of the Social Security packages that we're offering to you today in our comment box. We will be leaving this webinar live for the next 30 minutes, so we're not going to close it. So you can get into the comment box and either click on the link or copy and paste it, put it someplace else where it's safe. You can also get to our meeting links out on our website on the schedule a meeting tab, which is, if you lose the link somewhere. All right, great. Have a great night, folks, and we'll see you next month.
Night.
Good night.